it's not that difficult sometimes to feel confident that we're in a bubble. But what you can never feel confident about is how far does a mania go. You can't try to pick a top in a bubble because nobody knows. I've been long significantly, and I've been following it up with very close stops because this is the type of situation that can change easily.
Well, the S&P now at 7,600 points, its ninth consecutive week of gains and a new record high. Is this a melt-up or a trap? There's no better person that I can think of to answer this question than next guest, Jack Schwager, author of the legendary series of books Market Wizards. It's been popular for decades, and now his new release, Market Wizards, The Next Generation, is due next week to hit the bookstores.
Yes.
Jack, congratulations on your new release. And welcome back to the show.
Thank you, David.
You've inspired literally generations of people in finance. I was reading your book, Market Wizards, actually the second one, Unknown Market Wizards, back in university, before I knew anything about stocks. And so big fan of your work. Appreciate you coming on. I want to talk about current market conditions before talking about the new generation of traders that you've interviewed for your upcoming book. Now, you've told me on prior episodes on my show that you're not an indicators guy. Instead, you read price action and you look at failed signals being more reliable than signals themselves. Now, the S&P, like I said, just closed at 7,600 points. How would you approach the question I posited in the introduction, which is whether or not this is a melt-up that will continue or a trap for investors chasing the rally?
Okay, so I don't know. I never know. I never try to forecast. So basically, in the S&P, what you had is you did have a. Well, let me pull up a chart so I can look at it while I'm talking.
Yeah, let me do that. Well, I have the charts in front of me now, but you're welcome to.
Oh yeah, I'm just doing it. Oh yeah, so because I have marked. So basically, it's bullish until proven otherwise. But what you had was you did have a very bullish occurrence in the S&P, and I would say that's around the that occurred approximately mid-April actually, and what that was a breaking of curvature. So I mean, I look at a lot of chart things, and one of the things is if you get a curve pattern, either one that looks like a top or one looks like a bottom, and you break that curvature, that is in my mind a very good signal. All these chart so-called signals are always, none of them are definitive. It just says the odds are better that it'll go, in this case, up than down, and that pattern particularly doesn't occur that often. And it's one that I pay attention to. So that is something that turned me personally bullish at that point. And since then, there's been no reason to change that opinion. We've had the uptrend and consolidations with an uptrend. My assumption always is continuation unless proven otherwise. And so far, you had a consolidation form sort of around late April, and then you had another one more recently, and each of those has kind of resolved with an upside breakout. And right now, the market is in another small flag pattern. Again, my assumption is up, unless which. If it breaks on the downside, that will be the first indication. But so far, the market has not really given any what I would consider bearish signals. So, and the way I've traded it is through stock positions. Is I've been long significantly for me, not significantly in terms of money, but what I would consider significant in terms of my account size, and. Yes. And I've been following it up with very close stops because this is the type of situation that can change easily. And the one thing I would say as far as where where I would turn neutral to even negative without any particular signal is if you get a full measured move extension on this current swing. And in terms of the June S&P, that would be about 78.50 or so. So we're at 76.21, 78.50. So, another 200, 230 points would be a complete measured move extension. And that would certainly say the market should be near at or near an exhaustion point. And that's a number I'm looking to be, as a warning to not be long.
You said these conditions could easily change. Why do you say that?
No, I'm saying that if the market action changes,
Okay.
then it
Oh, I
changes.
see.
Basically, like I say, I don't do any. It's not forecasting, but the only thing
Right.
that would fall into the realm of forecasting is a market that's in a straight uptrend getting to a measured move extension. Measured move, for those who are not familiar, it's if you take the swing in the low in 2025 and take the relative high you had in early 26. Now, that's the last major move. If you then take that equivalent move from the recent relative low, that's the point where, which again should be around 78.50. That's the point where I would say the market is fully extended.
You mentioned being more cautious. What does that entail for you? Are you talking about shorter time frames, quicker exits, more stops, or something else?
If you looked at all my positions, you would see that they're all have very close stops. And I've been keeping the stops very close because we've had this straight up move, and it's very easy for that type of thing to break suddenly. Plus, even though I'm not a fundamentalist in any way, but I am cognizant that based on valuations, the market is pretty extended. It's on the historical high. It's at or beyond areas which have led to tops before. So it's definitely, the valuations are in an area where caution is merited. So, so I mean, like I say, I'm long, but the depth of my commitment is very shallow.
Before we continue with the video, I'd like to address one of the fundamental problems of owning gold. Now, gold is seen in most cases as a store of value, but it has one major problem. It doesn't generate a yield in itself. And that's where today's sponsor, Monetary Metals, comes in. Monetary Metals introduces a model where gold can produce a yield paid in physical gold. Through their leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces. That means your returns are measured in gold itself, not just in fiat currency terms. In an environment where many assets depend on price appreciation alone, this approach allows gold to serve both as a store of value and as a source of income. The metal remains your asset and can be redeemed at any time. Thousands of investors are already earning a yield on their gold through Monetary Metals, so visit their website today to get started and learn more. That's monetary-metals.com/Lynn. Link in the description down below, or scan the QR code here and get your gold to start working for you now.
The last two times since 2024, when we've had major drawdowns in the S&P, were geopolitical shocks. So Liberation Day in early 2025,
Right.
and exactly a year later, which is where we are now, the Iran war. And so both times have seen significant rebounds and then new higher highs. Is it safe to say that, Jack, in this administration, we can expect another geopolitical shock to be a good buying opportunity? Would that be a good way to approach the markets as a trader, you think?
Gee, I can only make that evaluation after it occurs, and generally, at least for the
But
recent.
how often do patterns repeat themselves? In your experience.
It's not. What's more significant, you mentioned the failed signal before, the fact that you had, I mentioned the breaking of curvature, but the fact that the market was ignoring what should have been bearish news is also bullish. And the same, well, although the April one was a pretty deep decline and more of a panic sell-off, So the market didn't ignore the news. It just had a very sharp sell-off and then came back off of it.
Okay. If you can jot your memory for us, Jack, and think back at the traders you interviewed around the dot-com era, maybe shortly before or even right after, what were they doing? And to the successful traders who maybe identified a bubble and got out early, what signals did they look at? And then we can bring it forward to today.
To emphasize is this came up in some interviews. Of course, it could only come up in interviews after 2000. But I remember at Hedge Fund Market Wizards, it came up, which was the book after, which was the first book after, it was a long time after 2000, but it was the first book after that point. The idea was that it was a number of traders. Oh, actually, even in Stock Market Wizards, John Bender, a major theme of his was that the market was way overextended. We were in a kind of a bubble. Well, a bubble is an easy way to summarize it. And he played it by putting on a huge short put, a long put position, and because he saw the action of the market with these stocks that had no earnings and no particular future going to these ridiculous levels, and for numerous reasons, he believed that we were kind of building to a major top. And so he did position for that. Now, he did it by buying puts, which limits the total risk. And of course, he proved dramatically right. In another interview, I think it was Kyle Moshe, was talking about that he also believed there was a bubble, but it's very, you can be pretty sure that something is, it's not that difficult sometimes to feel confident that we're in a bubble. But what you can never feel confident about is how far does a mania go? Like the NASDAQ at the time, I think the high was somewhere in the mid 5,000s, I think, ultimately. But it could have been the mid 6,000s. It could have been the mid 4,000s. Any of those people who thought the NASDAQ was in a bubble in 99 were certainly totally right, but they were just early. So it's very, very difficult to assess how far the market can go. And in a bubble, a market can go much further than people can believe. And I mean, the NASDAQ ultimately went down 80% from where it got to. So the market can get tremendously overextended. There's no way to know. So the other thing that came up in Market Wizard interviews is that you can't try to pick a top in a bubble because nobody knows unless you do it like Bender did by buying puts. If you do it outright, you have to wait for the market to actually break. Yes, you give up a good size initial swing, but you have to wait for that market to break and to have the proof at least that it's over or the odds look like it's over.
What do you think those same people would say today when confronted with trillion-dollar tech IPOs, Anthropic, for example, SpaceX, with less than $20 billion of revenue and more than $1 trillion in valuation? How do you think they would approach today's market?
Well, I mean, SpaceX, I know nothing, okay? I have no idea. But what I can say is the real money is going to be made by the initial investors before it goes public. And once it goes public, a lot of those investors will cash out. One thing to keep an eye on is there going to be a normal, and I'm not up to date on it, but is there going to be a normal 6-month wait, or are they going to shortcut it? But whatever price, wherever it ultimately goes, there's a good chance that when the initial investors can cash out, there will, that would be a point where you could get a big reaction, even if it ultimately goes much higher. But I just think, but at the price it'll come out, it's going to be a very high risk trade, and I'm personally ignoring it.
And this is the keyword, risk. So one of your famous conclusions after interviewing many, many people over several decades is that there's no one right way to win. There are many ways to win, but there's no way to win without risk management. So let's take today's example. You talked about this market being long or being bullish. Now, how do you manage risk in what many people would call a euphoric market? On the one hand, you could stay defensive and perhaps miss out on a lot of gains. And on the other hand, you could ride the wave, have very little stops or hedges, and get burned if it all crashes the other way unexpectedly. Both argue could be bad. How do you walk that line?
Yeah, well, for me, it's I certainly don't have. I certainly am not in the would not be in a buy and hold camp, because that does have a tremendous amount of risk. So, as I mentioned personally, the way I approach it is I wait for spots in different stocks where, for chart reasons, I think that there's a good chance the next swing will be up, and I enter a relatively close stop at the time I do the trade. So in any position I'm putting on, I'm risking very little, typically less than 1%.
Another commonality, I think the Wizards had made the most money when consensus was strongest. For example, Paul Tudor Jones before 87, Stanley Druckenmiller before major macro turning points. What would you say would be one or two of the strongest consensus talking points today?
Consensus talking points about what?
The markets. Basically, what are the strongest consensus views that the majority of investors or perhaps market participants are hurting into right now?
Well, I mean, we've talked about it. And essentially, on the bearish camp is that the market is very highly valued, and the bullish camp, well, it also comes down to where people are on the AI trade, which is basically driving the market. And I think both arguments can be convincing. Will these companies really be able to recoup the great expenditures they're putting into this thing? And the other danger there is, even if one or two wildly succeed, become the next Amazon, so to speak, there's some that can easily fail, right? So the market will ultimately, maybe it'll all get business, but there's a good chance that one or two will come out to be the dominant leaders, and that would leave the other ones in a high risk situation. I have no idea which ones, and I have no idea if that'll be the case, but we have seen this before, we have seen a lot of examples of this type of situation before. So like if it's Facebook versus, what was the name is slipping me, but the competitor Facebook at the time, both were reasonable prospects, I guess, but one went under and one thrived tremendously. So you could have a situation like that. So that means that any particular investment in one particular company could be open to that risk. But I have no idea. The market is kind of discounting a tremendous amount of success, and it may, if it's an Amazon, it could be underestimating it, and if it's one of these competitors that don't make it through, then it could be way over discount.
I want to transition to talking about your new book. Before we get into details, let me just set this up for the audience here. If you were to speculate in terms of how people will perform, do you think that the people that you interview for your first Market Wizards book way back in the 80s would still outperform markets today, in today's situation, given how far things have come and how things are different today?
Yeah, so I mean, you have people like Paul Tudor Jones, who I think Bruce Kovner, I haven't kept up to date in their performance. I think Kovner and Jones are good examples of people who, and Druckenmiller was the second book, which came only a few years later, and Druckenmiller is a particularly good example. But a number of the traders from those first two books, which go back to 88, 89 when the first one came out, and 92 when the second one came out. So there are a number of traders there that sort of adapt and thrive in almost any environment. But there are some traders that uh, did phenomenally well the book came out in the late 80s, and so their track record was late 60s, 70s, early 80s. A number of them were made their fortunes in trend following, and trend following as a general strategy has certainly lost a lot of its efficacy. So in those cases, I would say probably not. It depends on this particular strategy and style.
There was a time when betting on the market means being diversified across 400 something, 500 stocks. With concentration risk being so high today, and the S&P being so focused on tech or heavily weighted towards AI companies, do you think that buying the market really is essentially just buying a few stocks today?
Well, actually, you have I think you have more diversification uh, in the market behavior now than you do typically. I mean, you have groups of stocks that are doing tremendously well, say anything related to power or something like that. And you have groups of stocks that are doing terrible, like software. So I think you've got more diversification across different sectors than is typical. One thing, though, this recent move up has been broad in the sense that I haven't looked at it recently, but the last time I saw it was an equal weighted S&P is in new highs and doing well. So you got a bit of a dichotomy there. You have sectors that are doing tremendous and sectors that are doing terrible. So you have much more of a spread. You have much more diversification, I think, than is typical. On the other hand, the market as a whole, if you equal weight all stocks, is doing just fine. I guess the index has been representative of the market move.
I'm curious if one day you'll interview AI bots and ask AI bots how they're trading, but that day hasn't come yet. So tell us about some of the highlights from your more recent book, The Next Generation of Traders. I haven't read that book yet. I've read the new Market Wizards, who I guess at the time at the time the book came out were the next generation. That came out, I believe, early 90s, if I'm not mistaken. So early 90s to now, how are traders different?
Well, there's more. Traders are always different. So if you look at any of the Market Wizard books, the one versus the other, the traders are all different. But even internally within any given Market Wizard book, the traders are very different. That's one of the things that has come out of these the interviews I've gotten is that the successful traders pick a methodology that fits their personality, and that tends to be different for everybody. So while markets change tremendously, it's not like there's one strategy that is predominant in one book and another book. Basically, it's always changing, and the real change has been in the markets, because you've gone from, let's say, the first Market Wizards book, the track records that were formed then. We're talking about trading pits, right? We've gone from trading pits to electronic trading. We're talking about track records that were formed largely pre-PC. So that's a huge difference. I mean, back in those days, people didn't have the option to just look at charts on their computer, and they certainly didn't have vast amounts of different data that was easily available. So, and you have not only advent of PC, you have supercomputing. More recent years, you have AI. In the last decade or two, you've had a tremendous advent of quant funds. I mean, you had the quant funds even back in the late 1990s, but it's been particularly predominant in the last 20 years. And you've got these giant quant firms trading tens of billions with 100 plus PhDs, and so those are the dramatic changes. Traders, though, individually the Market Wizards seem to find their own methodology each time.
Are there different themes that, as a whole, traders are tackling this year and last year versus, let's say, 10, 15 years ago? For example, let's say early 2000s, everyone was focused on the China rising trade, right? And then, of course, there was a tech trade prior to 2000. Post 2008, it was the financial recovery. And then a couple of years ago, it was high inflation. What are people focused on now?
That varies from trader to trader. There's
Okay.
like I say, there's no dominant thing. The only thing I would say that was different in this book, in the upcoming book, is that a number of traders use strategies that never were mentioned in any prior book, and that were philosophically contradictory to the type of trading approach used by virtually all the other people I interviewed, and that is all the other books. If you drill down to, even though their methodologies were very different, if you drill down to what they were doing, it was basically an asymmetric type of trade. That asymmetry could have been achieved in many, many different ways, but essentially, whether they were chartist or pure fundamentalist or whatever, they were looking for situations where if they're right, they'd make a lot more than they lost. That was true of just about every trader I had interviewed in previous books. In this book, there were quite a few traders, maybe even like 30, 40% of the interviews, where they made their initial millions with by selling small cap, by going short small cap stocks, which is the epitome of the opposite of a positive asymmetry trade. It's a negative asymmetry trade, because the best you can do is the stock goes to zero, and some of these small caps, which they were selling always into massive rallies, some of those can go another 1,000%. You never know. So it was surprising, and a number of traders made their initial millions by predominantly using the strategy of selling small cap stocks that they perceive to be, essentially call it a pump and dump type of situation. Companies that had underlying structures where they were burning cash. They would do, let's say, a convertible odd deal to raise the cash, and with terms that were very negative for the stock. And on a significant rally, you'd get those bonds, let's say the conversion of those bonds, which would drive the prices down, and there was no reason for the stock ever to be up. So that's the type of strategy that a number of these traders use initially, although they all transitioned out of it because that strategy doesn't scale as they got past in the tens of millions, or in some cases in the hundreds of millions. Obviously, that strategy is no longer viable.
Have you asked these traders of the next generation, or this current new generation, if trading today is fundamentally more challenging as a profession than 35 years ago when you first started interviewing people? Because of the availability of technology, I would assume markets are now a lot more efficient today than the late 80s.
Yeah, and I would argue that's a reasonable assumption.
Yeah.
And it's what I assumed before my last book, which was Unknown Market Wizards, the initial draft, the initial original version coming out in 2020, and then the revised in 2022. But that's what I expected. What I found in that book, and what I certainly found in this book, were traders were having. We found I say we because I had a co-author in this book, George Coyle. We found traders for this book, and I found traders in the last book that had track records that either based on cumulative profitability, cumulative dollars made, or based on return risk, the track records that were as good, if not better, than anything I found in the early books, which included legendary traders. So if the markets were efficient, there shouldn't be traders. For example, one trader in the most recent book took a $40,000 account, and as the last time I spoke to him, he was up to $500 million. So 40,000, $500 million is as good as anything I've ever seen. So there are traders doing that, and that would not happen. That doesn't happen with luck. That's not. You can't get that with luck. You could. You can get a short-term run, but you don't get a 10-year run that turns 40,000 to $500 million.
Over the past 40 years since you've been doing this, what would be the strongest evidence you have to dispute or perhaps disprove the efficient market hypothesis, posited by many people, made famous by Eugene Fama, who I've interviewed before? The theory, and I'm simplifying this for the people watching the show, broadly states that you can't repeatedly beat markets over time because eventually information will filter out any luck. And so you can beat the markets 1 or 2 years, but eventually markets are efficient and it's just not feasible.
So I've found many traders who are walking refutations of the efficient market hypothesis. So in this book, you have one trader who hasn't had a losing month in like 15 years. Now, I should say that, of course, we always verify track records, but so one trader hasn't had, and in the book, we only talk about 11 years because prior to that, he was managing family money, and those numbers were not available. But I have no reason to disbelieve him. So I think we just asserted the 11 years as no losing months, not the 15. You don't get that if the markets are efficient. There's another trader who in like 20 years has had 5 losing months or whatever, small losses. And so again, that's now the one classic example from a previous book is Ed Thorpe in Hedge Fund Market Wizards, and I did a particular probability calculation there. So Thorpe ran his first fund 19 years. He had only 3 losing months in 19 years. All of those losing months were less than 1%. And I did a simple binomial probability calculation where I did a simplifying assumption that gains and losses were equal, which they were not, because his average gain was larger. And used this like only 3 losing months out of 19 years. And the probability, then the number was so extraordinarily large that I had to find a way to translate it to people so they had some sense of what that number meant. So I came up with the example that if you were to randomly pick an atom from the entire mass of the Earth, not just the surface, the entire mass, and then you were to repeat the experiment and randomly pick another atom, and you pick the same atom, that probability would be over 1 trillion times, or I forget how much, but will be tremendously larger than the probability of Thorpe's track record if the efficient market hypothesis were correct.
Did those traders the ones that didn't have a single loss over an extended period of time, did they beat the markets though, or were they just up?
Well, I mean, they're positive in that. Well, based on, here's the thing: the trader who never losing month. First of all, he's extraordinary risk averse, so he always kept on going back to the same small account size. So he literally trading. Well, we use nominally $100,000 to the calculation, but he typically has less than 100,000. But 100,000 was a conservative assumption, and on that assumption, he was making let's say $350,000 a year on $100,000. Always kept the same size and never had a losing month. So in terms of beating the market based on the count, I mean, killing the market and with no drug, with never a losing month. So so the answer is yes, but also not only was he so extremely risk adverse, his strategy couldn't scale. It could scale larger than he was trading it, but it couldn't. There's no way he could compound it. So the trade-off there is, yes, he can get a chart that is a money machine, but he can't compound it.
Okay, so here's I think the question that's been bothering me personally is the following. A new study from S&P 500, or S&P rather, Standard & Poor's, shows that roughly 90% of active public equity fund managers underperform their index, and 81% of active public fixed income managers underperform their index. So these are professionals who are a lot smarter than me, who know a lot more than me. And I'm reading your book. I'm reading a lot of other people. I'm interviewing yourself. I'm interviewing a lot of other people. And I'm thinking to myself, should I aspire to be the 10%? Or should I just buy the index? everyone wants to be the 10%, but mathematically, you're not the 10%, because by definition, if everyone's the 10%, you're not the 10%. You know what I'm saying? Why don't we? Why are we even doing this? Is ultimately my question.
Yeah. So the old fallacy. I mean, everybody believes they're above average, which obviously is impossible. But so first of all, that statistic you mentioned, that's been true. There've been studies forever. I don't know, probably hundreds of studies. And it's true every time. 91 is maybe on a high side, but it's always like 80% plus, I think.
Sure.
So, and that is, first of all, let me say that's a natural consequence of, if you take all these, and we're talking mainly, I think, mutual fund managers here, and basically, if you take all their portfolios, you really have the market. And so, if you have the market, but they're paying transaction costs. They have slippage on their trades. So it's mathematically impossible for the entire group to beat the market, because they are the market and they have costs that an index doesn't. An index just holds a position, and only once in a while, when there are changes in the index, does it have any transaction costs. So that will always be true. I mean, that's one thing I can predict, is forever that will always be true. Now, as far as whether should people try to beat the market or just go into an index fund,
yeah,
I have strong feelings there, and there is no one answer fits everybody. It depends on the individual. Now, if you're somebody who does not devoted tremendous amount of research time and has a lot of experience and has some particular methodology that you have reason to believe has an edge, then yeah, for those traders, you're better off just going into an index fund. Don't even try trading. One of the traders in this new book, Christian Kulamagi, sort of talks about his brother-in-law, and he's seeing him. Kulamagi took a $5,000 account into 100 million. Then he had a drawdown, but he did go up above 100 million at one point with a $5,000 account. So his brother-in-law is asked, "Can you teach me to trade?" And he says, "No, you shouldn't trade." He says, I was in my 20s. I spent 80 hours a week studying the market. I ate, slept. I just did nothing but research in the markets. You have a family. You're going to devote maybe an hour a day, if you're lucky, to the markets. There's no way you can do the same thing. So, his advice to some brother-in-law is, don't even try it. So for most people, unless they, like I gave the qualifications before, unless they fall into that category, you would be better off in an index fund. But if you do have an edge, then by all means, go for it.
Your book features a lot of anomalies and exceptions to exactly what you just said, though. Here, again, I haven't read the book yet. It's not out, but here's a synopsis on Amazon. A musician who dropped out of school to pursue a trading career, whose current accumulative profits total nearly 500 million. I think you mentioned this earlier. Yeah. A volunteer firefighter who has not had a single losing month in over 10 years of trading. I have a lot of questions about this.
Sure.
So the first question is, what do they do during COVID, during Liberation Day month, which was last year, during the Iran war, right? And then, there's several other bear markets that were drawdowns that I could name. I mean, did they predicted all of these, or were they just sitting on cash the whole time?
I'll give you a specific answer. Let's take the volunteer firefighter first, like we talked about before.
Sure.
And he has a specific strategy. He is extraordinarily expert at merger arb. So he's made a life study. And this is a guy who gets up literally at 3:45 a.m. to check the pre-market.
Wow.
And does his last look at the markets at 8 p.m. And in between, he takes some breaks a little bit, but for the most part, he's in front of the screen, not only for the full market session, but before and after as well. So that's not something that most people would want to do, nor would I recommend that as a lifestyle, but that's what he does. Now, the strategy is merger arb, but he's, like I say, extraordinarily expert at it. He knows all these He knows all the quirks, all about the filings. He knows what to look for in filings. For example, a trade he mentioned where example of a trade might be a merger arb deal is announced, market runs up, he goes short. Why? Because he looks at the filing and he notices that the filing is in Maryland and not Delaware. And that's not going to mean anything to almost anybody. But he knows that in Maryland, it's easy for the company to turn down the merger, to avoid it, and it's very different in Delaware. So, but that knowledge, and that's how he basically beats the bots at their own game, because he knows all these nuances that are just too sophisticated and too expensive to fully program in these bots that recognize a headline and trade instantaneously. Nobody can beat them. So, but that's his strategy. The musician has gone through many phases. He's one of the traders who initially shorted small cap and eventually went to trading mid. Eventually, ultimately, at this point, he's transitioned all the way from going short small cap for day trades that lasted a day or two to taking long-term position trades. So he's completely transitioned, but he's basically adjusted and adapted through his entire trading career. So there's no single answer on how he's done it, but whatever approach he used, he just devoted a lot of research to it.
People watching this will probably think to themselves, gee, a musician who dropped out of school, security guard, a volunteer firefighter, these aren't BlackRock execs. These are seemingly regular people. And if a regular person with a regular job can do this, so can I. What would you say to that?
Well, I think most people, if you did the amount of work and had the amount of devotion that these people did to trading, you probably can get the point of profitability. But I think there's another element to it. There's that type of rigorous commitment and passion and work to trading. That's part of the equation. But the other part of it is, I do believe that certain people just were born with something ineffable almost that makes them has the ability to excel in trading. Just like certain people excel in certain sports or whatever. I mean, not everybody's going to be a professional athlete in any given sport, no matter how hard they work. I would say it's no different than in trading. Some people just have the right genetic makeup. Like the musician, for example, says like one of the things that he knows about himself is that from a very early young age, he was always non-phased in terms of any crisis. He just was always calm. That was just no matter what. So this is a guy who's seen some enormous, when he's broken his own rules, has seen some enormous drawdowns, but he sort of has that composure to be able to be calm and despite being in a position that losing extraordinary amounts of money.
What was their approach to developing unique risk management tools and setups? You had people, Christian Kulamagi, I'm not sure if I'm saying his name right, turned $5,000 into a peak of $105 million between 2011 and 2021. He had setups that most traders never developed. It's very difficult to come up with something unique in an age where the amount of information we have and the technology that we have kind of forces people to converge into similar styles of trading.
Yeah, so you would think so. Actually, in his case, he basically, and this is interesting, he basically says, I think I'm getting exact word for word here, I didn't invent anything. Basically, he says, nothing I do is original. He ultimately, after all this research, came down to three types of setups. and which are discussed in the interview. And each of those setups he got from somebody else on social media. It's not
Yeah.
that he developed them, but he made them his own, and he married it ultimately with risk management. He's a guy who, the first 3, 4 times he tried trading, wiped out his small accounts, and he finally did it on the fourth or fifth time. And so he says quite explicitly, "I'm not doing anything original. I got ideas." He got his ideas off of social media, but the way he has traded them and the risk management he's used has made it possible for him to succeed. So
it's mathematically improbable to never have a losing trade. I'm not talking about a losing month. I'm talking about one losing trade. The difference between somebody like this guy or other people you've interviewed in your books and somebody who's not making profits is how you approach that losing trade, right? How do these people do it? What's their approach to something that's down?
So they basically, I guess, have different risk management approaches. In some cases, like the volunteer fireman or another, the fellow I mentioned who only had 5 losing months over a long period of time, both of them are just so extraordinarily risk averse that if they have a losing trade, it probably doesn't last 2 minutes. So they don't need they don't need stops. They watch the market, and or they may have a stop in as well, but they'll be out if a trade doesn't work. They'll be out in a couple of minutes, and even if a trade in the volunteer fireman example, even if a trade isn't losing money, but if he isn't ahead within 20, 30 minutes, in fact, he uses this time stop concept, he'll get out of it. So on one hand, you have traders who just get out almost instantaneously on the first loss. They're either right away or they're out. So that's one type of answer. Another type of answer is they just have risk level, or let's say Kulamagi, what he'll do is he'll use like simple moving averages if the move is going on, and and that'll be his first indication that something is wrong. Now he'll have a stop in anyway usually, but if a market's going sharply higher, he'll use a shorter term moving average. So the very first time, let's say he breaks a 10-day moving average, which is very easy to do for a price to break the 10-day moving average, he'll be out because that's just cuts his chances down of losing a lot of money. So that's another style. The musician who's up to half a billion, after having a couple of incidents discussed in the book, where he took these enormous losses by breaking his own rules, essentially, only a couple of times. But and interestingly, after we finished the book, after we finished the original chapter, he communicated back to us, saying that he just had his worst drawdown ever, and he didn't want to have the book come out without acknowledging that. So that's actually in the book but that last drawdown was so bad that after that drawdown he rebounded very quickly again. But that drawdown was so bad that he implemented very rigorous rules to protect himself against himself, and those rules include defining initially how much risk the trade is taking and tightening it up. So those are some of the answers.
Exiting a winning trade is equally important. Have these successful traders relied more on quantitative signals rather, or qualitative information like news or macro data that they think would turn the position?
Depends on the trader. Although I think for most of the traders, it ultimately became a combination of both fundamental and technical. Some traders were initially mostly technical based, one way or the other. But ultimately, just thinking off the top of my head, I think most of them use both fundamentals and technical.
Okay. Finally, so for somebody who may have read your prior books in years past, what do you think they will learn differently? Or, sorry, some new information they will learn or gain from reading your next book, The Next Generation of Market Wizards?
Well, one difference in this book versus all the other Market Wizard books is for the first time I included charts in the book. So there are some there's some maybe more explicit presentation of the trades that are discussed in the interview, and so I guess one thing is readers can see, at least for some of the interviews and some of the strategies used, what the trades look like and what the thinking was. But in general, I think in every Market Wizard book, some timeless lessons come across, like risk management, and they come across very strongly, explicitly and just implicitly through seeing the stories of these traders themselves. So, and then every trader and every reader or listener, if it's an audio, I find latches on to different chapters in the book as being personally relevant. So what anybody would get out of any particular chapter varies. And when people talk to me, who've read my books and say, what my favorite chapter is, I have no idea, because it's always something different. So what any reader or listener can get out of this book will depend on the individual.
Would you ever consider interviewing a unsuccessful trader, basically somebody who's lost a lot of money, and just we can learn from his mistakes?
Yeah, I mean, I've thought of that idea, and it's a good idea. It's an interesting idea. Now, part of the motivation to do that type of book is actually fulfilled in the Market Wizard books, because quite a number of the traders I've interviewed had early failures, or sometimes even after they were successful, have incidents of where they broke their rules and had a large loss. So some of that is in this book and in other Market Wizard books. But I think it's a good idea. One thing, if you just have a purely losing trader, you might have difficulty getting them. I am considering doing another book with my co-author in this book, George Coyle, where we just, not specifically a Market Wizard book, but where we kind of do a chapter on each chapter will be a different story somehow related to Wall Street. And one of those chapters that we have in mind will be an individual who ultimately is successful, but had a couple of enormous drawdowns, just mind-boggling. And so that the book we're very seriously considering doing would have that type of story.
And finally, into the future, do you think there's still a place for human traders? AI agents have emerged as having, in some cases, superior information processing skills. And we repeatedly read from your books and other people that some of the best traders trade without emotion, sticking to the rules, like you said, developing almost robotic processes. Well, who better to do that than a robot itself? So can AI just replace human traders in 20 years' time?
Yeah, okay. So you're right about a number of those things. I mean, AI does have a number of advantages. Certainly pattern recognition is kind of the essence of AI, and that's important in trading, and that would be certainly an advantage where AI can come up with strategies that humans can't come up with because of the complexity, that the patterns it can find. So that, and you say the non-emotionality, all of that is true. Now, I would say here's a saving grace. First of all, AI has been around at least for some, but in some form it's been around for some years now, and I'm still finding traders with exceptional performance. So apparently, for now, it's still the potential to be able to do not only beat the market but beat it by miles is still apparently there. And I'm not finding, obviously, all the traders that do that. I'm finding a sampling of them. So that it's not been human trading has not yet been negated for sure. Now, there is the saving grace. I would never underestimate AI because the progress that's going on now is exponential. Once you get to AI helping design the next version of a particular platform, you're into an exponential stage. So I would never underestimate that. But there is an inherent basic saving grace here, and that is the markets are different than anything else. It's not like using AI to find a drug combination that can cure some disease, and there are like trillions of drug combinations that could be, have to be tried and experimented, but AI can kind of shortcut that process. But that's because science, biology, physics, the rules that govern it don't change. It's not like proteins say behave in one way, today, and then 10 days from now they behave some different way. It's not like the rules of gravitation change. It's not like anything quantum mechanics. All of the rules that drive the world, are fixed. They don't change. So those problems can ultimately be solved by enough processing power. Something like climate, which is extremely complex, ultimately can probably be refined more and more in terms of AI being able to come up with predictions that are more accurate than humans ever could have done. So yes, in those cases, AI will beat humans in all cases. Ultimately, doctors, I think, ultimately will be using AI as a diagnostic tool, but they will never be able to outperform what AI will eventually be in terms of diagnostic capability. The difference in the markets is the rules change all the time. Simple examples. Sometimes bonds and stocks are positively correlated. Sometimes they're negatively correlated. Sometimes they're uncorrelated. So the same types of things. So that means if you get an interest rate hike or something, it can, or an unemployment drop or raise or whatever. Any of those things sometimes can be positive, sometimes can be negative. The rules are always changing, and that would make it more difficult for AI to come up with any types of. It wouldn't come up with the absolute solutions. So I think always is a dangerous word, but I think for a good length of foreseeable future, there'll still be a place for humans. Just because the markets are a different type of problem, they don't have the advantage of having fixed rules.
Okay, Jack, thank you very much. We mentioned your book that's coming out. I believe it's out next week, the 9th of June. Anywhere else we can go to follow your work besides your upcoming book?
No, nothing special on it.
Okay.
Yeah.
All right, good. Well, we look forward to reading Market Wizards, The Next Generation. So do stay tuned for that book release. Thank you very much, Jack, and I appreciate your insights. Take care for now. Thank you for watching. Don't forget to like, subscribe.